You know that feeling? You're doing everything right. You're working hard. Maybe you even got that promotion last year. You're paying down your credit cards. You're being responsible. And yet, every time you look at your bank account, it feels like you're just treading water. Not drowning, exactly, but definitely not moving towards the shore. There's this constant, low-grade hum of financial anxiety that just lives in the back of your head. And for a lot of people, that anxiety has a very specific shape. It's the shape of a down payment. You've been told your whole life that the ultimate sign of making it is owning a home. And not just owning a home, but doing it the right way. Saving up that massive, mythical 20% down payment. It feels like a badge of honor, a sign of fiscal discipline. It's what your parents did. It's what every financial advisor on TV says to do. It's the safe route. My name is Ford, and I spend way too much time obsessing over money psychology. The gap between what we're told to do with money and what actually creates wealth is so wide you could drive a truck through it. And this obsession with the 20% down payment, honestly, it's one of the biggest, most well-intentioned traps in personal finance. It's a trap that keeps people renting for a decade longer than they need to. A trap that forces people to drain their entire life savings, leaving them financially naked and vulnerable the moment they step through the front door. We're going to talk about the secret that wealthy people understand about real estate, the one that flips the entire script. It's not about avoiding debt. It's about understanding the difference between good leverage and bad leverage. It's about opportunity cost. It's about realizing that the path to building real, lasting wealth isn't about playing defense by hoarding cash for a decade. It's about playing offense with your money. And today, we're going to level up your entire understanding of what it means to buy a home. Let's start with what I call the rat race level. This is where most people are stuck. Level 1, the grind. You've set a goal. I need to save $80,000 for a $400,000 house. That's the magic number. So you start the grind. You're packing lunches, you're skipping the vacation, you're driving that older car a little longer. Every spare dollar gets funneled into a savings account. For years, 5, 6, 7 years, you're watching that balance creep up. $10,000, $30,000, $50,000, and you feel this mix of pride and exhaustion. Pride that you're doing it, exhaustion, because the finish line feels so far away. But here's the psychological kicker, and it's a cruel one. While you're grinding, two things are happening. First, the housing market is moving. It's not standing still waiting for you to catch up. That $400,000 house you were saving for 5 years ago is now $500,000. So your goalpost just moved. Now you need $100,000. It's like running on a treadmill that keeps increasing its speed. The harder you work, the further the finish line seems. And second, you're sitting on a pile of cash that's losing value every single day to inflation. The very discipline you're showing is quietly eroding your purchasing power. So you finally get there. You've saved the mythical 20%. You've sacrificed years of your life, years of experiences, years of compounding growth in the stock market. You feel a sense of accomplishment, sure, but also a deep sense of depletion. You hand over that massive check to the bank, and now you're in the house. Congratulations. But now, you're cash poor. You have a mortgage, you have property taxes, you have maintenance, and you have absolutely zero safety net. That emergency fund you had, it's gone. It's all tied up in the four walls around you. One roof leak, one HVAC breakdown, one unexpected job loss, and suddenly you're not a proud homeowner, you're a stress case. One missed payment away from losing it all. This is the trap. This is the safe route that leaves you more vulnerable than when you started. Let's rewind. Let's imagine a different path. Let's call this level 2, the leverage level. Instead of the goal being save 20%, the goal shifts. The goal becomes secure the asset with as little of my own capital as possible while protecting my liquidity. Because cash isn't just cash. Cash is options. Cash is safety. Cash is the fuel for every other opportunity. I remember talking to a buddy of mine. Let's call him Dave. Dave and his wife were in this exact spot. They had about $50,000 saved. They were looking at houses in the $400,000 range. They were heartbroken, honestly, because they thought they were nowhere close. They were about to resign themselves to another 3 years of renting, another 3 years of the grind, to get to that 20% down payment. And I asked them why. They looked at me like I had two heads. Because that's what you do, so you don't pay PMI. PMI, Private Mortgage Insurance. This tiny 3-letter acronym is the boogeyman of personal finance. It's the thing everyone is terrified of. They treat it like a scarlet letter of financial irresponsibility. And look, PMI is not fun. It's an added cost, but we need to put it in perspective. On a $400,000 loan with 5% down instead of 20%, PMI might be $100 to $200 a month. Let's say it's $200 a month. Over the course of a year, that's $2,400. Now, compare that to the alternative. The alternative was them waiting 3 more years to save the additional $60,000 they needed for the 20% down payment. In those 3 years, they'd be paying rent. Let's say their rent was $2,000 a month. That's $72,000 in rent over 3 years. $72,000 that builds them zero equity. Gone. So the choice isn't pay PMI or don't pay PMI. The choice is pay PMI for a few years until you refinance, or pay $72,000 in rent while you desperately try to save a mountain of cash. But that's just the surface. The real magic here, the thing that changes the entire trajectory of a person's financial life, is what you do with the cash you didn't put into the down payment. Let's go back to Dave and his wife. They had $50,000. Instead of putting all $50,000 into a 20% down payment they didn't have, they put 5% down. That's $20,000. They kept $30,000 in the bank. Immediately, the psychological burden lifted. They weren't cash poor. They had a safety net. That alone is worth its weight in gold. That's the difference between lying awake at night worrying about a job loss and sleeping soundly knowing you have a year's worth of mortgage payments in the bank. But level 2 isn't just about the safety net. It's about the opportunity. That $30,000 they kept, that's not just emergency fund money. That's seed capital. Here's where most people get it wrong. They see a house as the ultimate investment. It's not. A house you live in is a place to live. It's an expense, a very large, very illiquid expense. Yes, historically it appreciates, but after you factor in maintenance, property taxes, insurance, and the interest on your loan, the average rate of return for a primary residence is actually pretty modest. It's not a wealth builder, it's a wealth preserver. At best, it's the shell you live in. Wealth is built with assets that generate cash flow, and you cannot generate cash flow with cash that's locked inside a wall. So let's fast forward 3 years. In the traditional path, Dave and his wife are finally moving into their house. They're exhausted, they have no savings, and they're starting from scratch. In the alternate path, Dave and his wife have been in their house for 3 years. They've been paying PMI. It's annoying, sure, but they've been living their lives. More importantly, they took that $30,000 they saved and they put it to work. Maybe they didn't put it all in the stock market. Maybe they took 20 grand and used it as a down payment on a small rental property, a duplex, or a condo in a growing area. Now, instead of just having one mortgage, they have a tenant paying down a second mortgage for them. That property is generating cash flow. It's an asset that is actively working for them while they sleep. Or maybe they took that $30,000 and, because they weren't desperate for every single dollar, they were able to invest consistently in a low-cost index fund. Over 3 years, with average market returns, that $30,000 could be $40,000. And that's just the start. That money is going to compound for the next 30 years. See the difference? In one scenario, you have a house and zero cash. In the other scenario, you have a house, a fully funded emergency fund, and a separate investment portfolio, or a second property that is generating wealth independent of your labor. This is level 3, the opportunity cost awakening. Once you understand opportunity cost, you can't unsee it. Every dollar you put into a 20% down payment is a dollar that is not working for you in the market. And the market over the long term has historically returned 7.10% on average. Real estate appreciation on a primary residence is historically around 3-4%. You are literally taking money that could be growing at 10% and stuffing it into a slow-moving asset that you can't easily access. But here's where the psychological hurdle gets really, really high. And I want to be honest with you because this is the part I struggled with myself. The hurdle is fear. And it's not just fear of debt. It's fear of looking irresponsible. We live in a culture that has a very specific, very loud narrative about what it means to be good with money. And that narrative says, avoid debt at all costs. It says, pay cash for everything. It says, the 20% down payment is the only prudent way. And look, I get it. I grew up with that voice in my head. It's a security blanket. The idea of putting down 5% feels wrong. It feels like you're overextending. It feels like you're being reckless. It's the same feeling you get when you're about to do something your parents told you never to do. But here's the thing. That advice, The Save 20% advice. It was written for a different era, an era before FHA loans, before 3% conventional loans, before the internet made investing accessible to everyone. It was advice for a world where the only two options were a 20% down payment or a predatory subprime loan. That's not the world we live in anymore. And the fear? The fear of PMI? That's a manufactured fear. It's a bogeyman designed to keep you in the safe lane. It's a fear that keeps you renting longer, keeps you from building equity, keeps you from deploying capital into higher return assets. Let's talk about level 4, the flexibility factor. One of the biggest, most unspoken costs of a 20% down payment is the loss of flexibility. When you put all your money into a house, you are chaining yourself to that house. If a job opportunity comes up in another city, too bad you can't move because you have no savings to cover the gap. If an incredible investment opportunity comes up, too bad. All your capital is illiquid. By keeping your cash, you maintain optionality. You keep your life flexible. You are not a prisoner of your balance sheet. I want to give you a vivid story, not a hypothetical one, but a composite of about 50 conversations I've had with people over the years. Let's call her Sarah. Sarah was a teacher. She had a dream of buying a small bungalow. She had $40,000 saved. Every single person in her life told her to wait until she had $60,000 to get to that 20% down. Wait. She was miserable in her apartment. Her landlord was raising the rent. She felt like she was throwing money away, but she was being responsible. She kept waiting. Another year went by. In that year, interest rates went up. Now, even with the 20% down, her monthly payment was going to be higher than if she had bought the year before with 5% down. And house prices in her area jumped another 8%. Her $60,000 goal was now $70,000. She was further behind than when she started. Finally, she said, screw it. She found a lender who offered a conventional loan with 5% down. She bought the bungalow. She paid PMI. Her payment was actually lower than the rent she had been paying because she bought before rates climbed too high. But here's what happened next. She took the remaining $20,000 she had saved and she didn't blow it on furniture. She invested it. She opened a brokerage account. She started learning. A few years later, that $20,000 had grown to over $30,000. She had a safety net. She had a house that had appreciated in value. And then an opportunity came up. A colleague was retiring and wanted to sell their small rental condo across town. She was able to use the $30,000 she had grown to make a down payment on that condo. Today, Sarah is a teacher. She's not a real estate mogul, but she owns 2 properties. One she lives in, one that pays her a passive income every month. She built that by not following the Save 20% rule. She built it by understanding the difference between being cash poor and being asset rich. Now, I want to be crystal clear about something. I'm not saying you should buy a house with zero money down. I'm not saying you should stretch yourself to the absolute limit of what a bank will approve you for. That's a whole different kind of mistake. The mistake is the dogmatic, inflexible rule that 20% is the only way. The mistake is treating PMI like a poison when it's actually just a small toll to get on the highway of wealth building years earlier. The key is to understand the math and the psychology. Run the numbers. What is your PMI payment? What is your rent? How many years will it take you to save that 20%? What is the opportunity cost of that cash sitting idle? You might find that the cost of waiting, in terms of rent paid, appreciation missed out on, and time out of the market, dwarfs the cost of PMI. This is level 5, the wealth mindset shift. And this is the final level. This is where you stop seeing money through the lens of scarcity and safety and start seeing it through the lens of utility and growth. The average person sees a big pile of cash and thinks, how can I use this to eliminate risk? They pay down the mortgage early. They put 20% down. They hoard it. They are playing defense. The wealthy person sees that same pile of cash and thinks, how can I use this to create more cash flow? They use leverage. They use other people's money, the bank's money, to buy assets. They keep their own capital liquid and deploy it into opportunities that generate a return higher than the cost of the debt. It's not about being reckless. It's about being strategic. It's about understanding that not all debt is created equal. The debt on your primary residence is probably the cheapest, safest debt you will ever have access to. The interest rates are low. The terms are long. It's a gift. And a 20% down payment is essentially you saying to the bank, no, I insist. I don't want to use your cheap money. I'll use my own expensive money instead. You are trading your most valuable asset, your liquidity, for a slightly lower monthly payment. And that trade-off for most people is a terrible deal. So, what does this mean for you? What's the actionable advice? Number 1, stop obsessing over the percentage. Start talking to a lender. Find out what your options actually are. There are conventional loans with 3% down. There are FHA loans with 3.5% down. There are VA and USDA loans with 0 down. You might have way more options than you think. Number 2, run the real math. Don't just listen to the fear. Calculate how much rent you'll pay over the next 5 years if you wait to save 20%. Compare that to the cost of PMI over the same period. Compare the potential appreciation of the home. Compare what that down payment money could be doing for you in the market. Put it on a spreadsheet. The numbers will speak for themselves. And number 3, protect your liquidity. If you decide to put less down, do not then go out and spend your savings on new furniture and renovations. That money is your lifeline. It's your emergency fund. It's your seed capital. It's your freedom fund. Guard it like it's the most important thing in the world, because it is. Look, the goal isn't to own a house. The goal is to build a life of freedom and security. A house is just one tool in the box. And if you use that tool the wrong way, if you use it to drain all your resources and strap you down with anxiety, it becomes a weight, not a foundation. The 20% down rule is a relic. It's a one-size-fits-all prescription that ignores the reality of today's housing market, the power of low-interest leverage, and the incredible opportunity cost of idle cash. The real financial milestone isn't handing over a huge check to a bank at a closing table. The real milestone is understanding the game well enough to know you don't have to. It's realizing that your cash is your power, your flexibility, your ability to sleep at night, and your ticket to the next opportunity. So, if you're out there right now, grinding away, feeling like the finish line keeps moving, feeling exhausted and frustrated because that 20% goal seems impossible, I want you to take a deep breath. There's another way. The path doesn't have to be a decade of sacrifice followed by a decade of being cash poor. You can build wealth and buy a home at the same time. You just have to stop playing by the old rules. Thanks for watching. I'll see you in the next one.